Welcome to the deep dive. You've handed us quite a stack today. Sources, notes, articles, all focused on personal investing and building wealth. It's a massive topic, isn't it?
It absolutely is. And, for a lot of folks, it feels like trying to navigate a really deep ocean without a map. Kind of intimidating.
Totally. So our mission here is to take this specific material you've gathered and really, well, unpack it. We want to pull out the most important nuggets, the actionable stuff, and help you understand the basics, sure, but also the strategies and nuances that popped up in these sources.
Exactly. Think of us as maybe your guides through this particular set of information, whether you're just starting out, maybe looking to tweak your approach, or, just curious about how building wealth actually works. We're here to try and make sense of it with you.
Okay, let's dive in. Investing. It's not some, secret club just for Wall Street types, right? As these sources really highlight, it's a fundamental tool for anyone looking to build a more secure financial future. Over time, that is.
And it's interesting how the sources frame it. It's not just about buying things, buying assets. It's described more as a strategic allocation of resources, mostly money, obviously, with a clear expectation, a hope of generating income or seeing that value grow.
So making your money work for you.
Pretty much.
Right.
And we'll look at the main ways these sources talk about stocks, which is owning a piece of a company, bonds, where you're essentially lending money, real estate, actual property, and things like mutual funds, which kind of pool everyone's money together.
Okay. So one of the very first things that just leaps off the page right at the start of these materials is the huge advantage of starting early. They really hammer this point home.
They do. And when you dig into the why, it really boils down to compound interest. It's sometimes called the eighth wonder of the world, and for good reason.
Right.
The sources use a pretty powerful example. Imagine investing, say, just $5,000 when you're 25. And then someone else invests the same $5,000, but they wait until they're 35.
Okay, so just a 10-year delay in starting. What happens?
Well, let's say both investments average a 7% return each year. Over 40 years, that $5,000 you started at 25. It could grow to roughly $45,000 by retirement.
Wow.
But the same $5,000 started just 10 years later at 35. It might only reach about $22,000.
That's less than half.
Yeah.
For just waiting a decade.
Exactly. It's a massive difference from what seems like a small delay. It's pretty wild, isn't it?
Yeah, really is.
And the sources point out other perks, too. Starting younger often means you can handle more risk simply because you've got more time to recover if the market dips.
Makes sense.
Your investment horizon, the time you have, is longer, which just gives more years for that growth potential to, kick in. And maybe just as importantly, it helps build financial discipline. Getting into that habit of saving and planning early, it sort of becomes second nature.
I remember reading their anecdote in one of the sources about a friend who started putting money into their 401k in their early 20s. It wasn't like a ton of money at first. Yeah. But just seeing it grow over that first decade or so, it really instilled this strong sense of financial responsibility. It became less about the dollar amount and more about the habit itself.
That's a perfect illustration. Those small early steps compound in terms of behavior, not just money.
Okay, so starting early gets the ball rolling. But like you said, it's a journey and you need a destination. The sources make a really strong case for setting clear financial goals. Investing needs direction, right? Like plotting a course on that map.
Absolutely. Think about it without specific goals. Investing is just kind of hoping for the best.
Yeah, vague hope.
Exactly. The sources really emphasize making goals specific and measurable. This brings amazing clarity and focus. If your goal is, say, saving $20,000 for a down payment on a house, that's a concrete target.
Right.
And that concrete target directly helps you make decisions like, okay, maybe I do need to cut back on eating out so much or whatever the unnecessary expense is. It gives budgeting a purpose.
It turns saving from this abstract idea into something tangible you're actively working towards.
Precisely. And goals provide motivation and accountability. When the market inevitably gets choppy, having that tangible target, that house, that retirement number, helps you stay the course.
Keep your eyes on the prize.
Yeah. And they give you a benchmark, a way to measure your progress. Are you on track? Do you need to save more, or maybe adjust your investment strategy?
The sources break goals down into timeframes, which seems sensible. Short term, like under a year, maybe an emergency fund, paying off high-interest credit cards.
Yep.
Then medium term, 1 to 5 years, that down payment example, or saving for education. And then the long-term stuff, 5 years or more retirement, obviously,
Yeah.
or just general wealth building.
Exactly. And they wisely suggest breaking down even those bigger goals into smaller chunks. Like
Right.
setting aside a specific amount every month for your emergency fund, it feels way less overwhelming than staring at a goal of, say, 6 months of living expenses all at once.
Yeah, bite-sized pieces.
Makes it achievable.
That story about the friends saving for a dream vacation by cutting back on dining out. It's simple, but it really shows how hitting one small financial goal can build confidence. It fuels you for the next bigger goal, Like, okay, I did that. What's next?
It's that feeling of empowerment, yeah. Realizing you can actually control your financial future.
Okay, so we've charted the course, set the destination. Now, a concept that comes up again and again in your sources is like a fundamental safety net. Diversification and asset allocation. The old classic, don't put all your eggs in one basket.
It really is fundamental. Diversification just means spreading your investments across different types of assets, stocks, bonds, real estate, maybe some international things, to lower your overall risk.
Okay.
The sources used a great analogy, throwing a party with lots of different kinds of food. If one dish isn't popular, or maybe even goes bad, your guests still have plenty of other options. Your party isn't ruined.
So if one type of investment tanks,
Yeah.
hopefully, the others can kind of cushion the blow.
Right. The main benefits highlighted are, 1, risk reduction. You're less vulnerable if one specific area performs poorly. 2, potentially greater returns because you're tapping into growth opportunities across different sectors, not just betting on one. And 3, usually a smoother investment experience. Less wild swings means less stress for you.
Makes sense.
The sources gave a clear example. Imagine tech stocks plummet during a downturn. If you also held, say, utility stocks, which tend to be more stable, their steadiness could significantly soften the hit from the tech drop in your overall portfolio.
Right, okay, that's diversification, spreading it out. So asset allocation, that's how you divide the money among those different baskets.
Exactly. It's deciding the specific percentages you'll commit to stocks versus bonds versus cash, and maybe other things, based very personally on your goals, your comfort level with risk, and your investment timeline. It's the strategic blueprint.
And the sources mention a few common ways people figure this out.
Yeah, some rules of thumb. There's age-based allocation. A really simple one is subtracting your age from 100, or sometimes 110 or 120 now, to get a rough starting percentage for stocks. So a 30-year-old might think about, say, 70% stocks, 30% bonds. Just a guideline, though.
Just a starting point.
Absolutely. Then there are target date funds. These are really popular in 401ks. They automatically shift your mix over time, becoming more conservative, more bonds, less stocks as you get closer to your target retirement year.
Kind of does the work for you.
To an extent, yes. And crucially, there's assessing your own risk tolerance. Often involves filling out a questionnaire to figure out if you're more aggressive, more conservative, or somewhere in between. That helps tailor the allocation to you.
And it's definitely not a set it and forget it kind of thing, right?
Yeah.
You have to revisit this.
Oh, absolutely vital. Life changes, markets change, you need to review and adjust. The sources shared that story about a friend who was initially only in tech stocks.
Ooh, stressful.
Incredibly stressful with the volatility, so they deliberately restructured, adding bonds and broad index funds. It led to a much more stable, less anxiety-inducing investment experience for them. That wasn't just a numbers decision, it was about their well-being, driven by better diversification and allocation.
That's a great point. Strategy affects your peace of mind, too.
Yeah.
Okay, speaking of stress, investing always involves some level of risk. So managing that risk seems like a huge piece of this.
It is. You can't avoid risk entirely, but you can manage it. The sources are pretty clear about the common types you face. There's market risk, that's the big one, right? The risk of losses just because the overall market goes down.
That's the one everyone sees on the news during a crash.
Right. Then there's credit risk, mainly with bonds. It's the risk that the company or government you lent money to can't pay you back your interest or principal.
Okay.
Liquidity risk. This is about how easily you can sell something without affecting its price. Selling a house quickly might mean taking a lower offer, whereas selling a popular stock is usually pretty instant.
Right, some things are easier to turn back into cash than others.
Exactly. And interest rate risk, which mostly impacts bonds. If interest rates in the economy go up, the older bonds you hold paying lower rates become less attractive, so their market price can fall.
Okay, quite a few potential pitfalls there. So how do the sources suggest we, defend ourselves? What are the strategies?
Well, guess what comes up first again? Diversification.
Oh, okay. Message received.
It's your primary defense. Spreading investments is key. They also talk about setting stop-loss orders. These are automated instructions you give your broker to sell a stock if its price drops to a specific level you set. It helps limit potential losses.
So it's like an automatic emergency brake if a stock starts falling fast.
Kind of, yeah. It can prevent a small loss from turning into a huge one. Regular portfolio reviews are also critical, checking in periodically to make sure your investments still align with your goals and your risk tolerance hasn't changed.
Like that example of someone getting closer to retirement.
Precisely. They'd likely want to shift towards lower risk assets to protect what they've accumulated. Investing in broad index funds or ETFs is another strategy mentioned. They give you instant diversification across many companies, often at a low cost.
And just knowing stuff helps.
Absolutely. Educating yourself is a risk management tool. Understanding basic economic factors like how interest rate changes might affect your bonds helps you make rational decisions instead of reacting emotionally to headlines. The sources had that specific story, remember? A friend's portfolio got hit by some unexpected regulatory news affecting tech stocks.
Right.
They used a stop-loss order on their most volatile holdings. It limited the damage, sure, but more importantly, it gave them breathing room to calmly reassess their whole strategy instead of just panic selling everything.
That really shows how being prepared makes a difference in the moment. Okay, so we've got the why, starting early, the what, goals, the how, diversification, risk management. Now, let's get into the where the actual investment options discussed.
Right, the tools in the toolbox. The sources give a good overview, starting with stocks. Like we said, buying stock means buying ownership in a company. They offer the potential for high growth if the company does well. Historically, the sources note, stocks have averaged around 7–10% annual returns over the long haul, even after inflation.
So that's where the significant wealth building potential often lies.
Often, yes. The benefits are that high growth potential plus potentially dividends. Many companies share profits with shareholders, providing an income stream and that ownership stake, which sometimes comes with voting rights. The anecdote shared was about someone investing in a promising tech company early on and watching its value grow dramatically. Classic stock success story.
And what about bonds? They seem like the opposite end of the spectrum.
In some ways, yeah. Bonds are basically loans you make to a government or a corporation. They promise to pay you back your principal at a set date, maturity, and pay you regular interest along the way. Generally considered safer, less volatile than stocks.
So more predictable.
Usually. Their benefits are that steady income stream from interest payments, typically lower risk compared to stocks, and they offer good diversification benefits often. When stocks go down, bonds might hold steady or even go up, though not always. I recall the example of advising a family member on municipal bonds for retirement savings, specifically for that steady, often tax-free income.
And then there's real estate, bricks and mortar.
Right. This can mean owning physical property directly, like a rental house or apartment building, or investing through REITs, real estate investment trusts, which are companies that own or finance income-producing real estate and trade on stock exchanges like regular stocks.
Okay, so different ways to get exposure.
Exactly. Benefits include owning a tangible asset, potential for income generation through rent, and certain tax advantages like deducting mortgage interest and depreciation. The story that stood out was the friend who bought a duplex.
Right, the rental property.
Yeah, they got consistent cash flow from the renters, the property value increased over time, and they ended up making a substantial profit when they sold it. Shows the potential there.
So stocks for growth, bonds for stability income, real estate as a tangible asset. Got it. Now, once you actually start making money from these, the sources talk about keeping more of it, right? Taxes.
Yes. The inevitable taxes. They can take a real bite out of your investment returns if you're not careful. The sources really stress how important tax efficiency is.
It's not just what you make, it's what you keep.
Precisely. Smart tax planning is crucial to maximize your after-tax returns. You want to leverage things like tax deferral, letting your investments grow without being taxed each year, which certain accounts allow. And planning helps you avoid nasty surprises, like selling an investment and suddenly finding yourself in a higher tax bracket because of the gain.
Ouch.
Yeah, one person in the sources shared that exact lesson, selling stock for a nice profit, but not thinking about the capital gains tax. The tax bill ended up being way higher than expected, shrinking the actual profit significantly.
A painful lesson indeed. So what are some of these tax-smart ways to invest?
Retirement accounts are the big ones, things like 401ks and 403bs, usually through your employer. Often your contributions are pre-tax, meaning they lower your taxable income now, and everything grows tax-deferred until you take it out in retirement.
Plus the employer match potential.
Huge. That's free money. Then there are traditional IRAs, which can offer similar tax deductions and tax-deferred growth. And Roth IRAs? These are really interesting. You contribute after-tax money, so no upfront deduction. But all the growth and all qualified withdrawals in retirement are completely tax-free. Fantastic if you think you'll be in a higher tax bracket later in life. For the self-employed, SEP IRAs offer higher contribution limits, also with tax advantages.
And what about HSAs? I hear those mentioned a lot.
Health savings accounts, yes. If you have a qualifying high-deductible health plan, they're amazing. They offer a triple tax advantage. Contributions are tax-deductible, the money grows tax-free, and withdrawals are tax-free if used for qualified medical expenses. Incredible tool. The sources also mention tax-efficient funds, specific mutual funds or ETFs, designed to minimize the taxes passed on to you. They tend to buy and hold, having low turnover, so they don't generate as many taxable capital gains distributions each year. And municipal bonds, the interest they pay is often exempt from federal income tax, and sometimes state and local, too. Very appealing for people in higher tax brackets.
Okay. And one more strategy mentioned was tax loss harvesting. Sounds kind of technical.
It's a bit more advanced, but the concept is simple. You strategically sell investments that have lost value. This generates a capital loss on paper. You can then use that loss to cancel out or offset capital gains you've made by selling other investments that went up.
So the loss reduces the tax you owe on the gain.
Exactly. It can significantly lower your overall tax bill for the year. The example given was someone who sold property for a big gain but then sold some underperforming stocks at a loss. The stock losses helped offset the property gain, saving them a bundle on taxes.
Okay, so being smart about taxes is clearly a big lever you can pull. Right? We covered a lot of the pieces. Starting early, goals, risk, options, taxes. How do we put it all together? Build that strong overall portfolio.
Yeah, bringing it all home. The sources circle back strongly to portfolio diversification here. It's not just about safety. It's essential for achieving long-term goals. It means deliberately spreading your money across those different asset classes we talked about. Equities, stocks for growth, fixed income bonds for stability and income, maybe some real estate, maybe even commodities like gold or oil as a potential hedge against inflation.
Is that where rules like the 60-40 split come in? 60% stocks, 40% bonds.
That's a common starting point, yeah, mentioned as a simple guideline. But the sources are quick to point out, and rightly so, that it's just a template. Your ideal mix really depends on your personal risk tolerance, your goals, your timeline. Remember that conservative friend example? Their portfolio might have been more like 30% stocks and 70% bonds, because their main goal was security, not maximum growth.
Right, tailor it to yourself. And once you set that allocation, you mentioned earlier, it drifts. So rebalancing comes into play.
Absolutely critical. Over time, some investments will do better than others. Your carefully chosen 60-40 mix might become 70-30 or 55-45 just through market movements. Rebalancing is the process of periodically buying or selling assets to get your portfolio back to its original target percentages.
How often do you need to do that?
Different approaches. Some people do it on a regular schedule, say every 6 months or once a year. It enforces discipline.
Right.
Others use threshold-based rebalancing. They only act if an asset class drifts too far from its target, maybe more than 5% or 10% away. This might mean less frequent trading, but responds directly to market shifts.
Or you could just use new money.
That's a really smart way, especially in taxable accounts, to avoid selling winners. If you're adding new money regularly, you can simply direct those new contributions towards the asset classes that are currently under their target percentage. It gently nudges your allocation back in line over time.
Clever.
Yeah. The anecdote shared was someone realizing their stock allocation had gotten way too high after a strong run in tech. Instead of selling a load of stocks and potentially triggering taxes, they just funneled their next few contributions entirely into bonds to bring the overall balance back towards their target and lower their risk.
That makes a lot of sense. It's like gently steering the ship back on course rather than making sharp turns.
Exactly. And speaking of steering, you got to keep checking the map, right?
Monitoring performance.
Vital. The sources stress regular monitoring. Not obsessively day to day, but checking in periodically to see if your portfolio is behaving as expected and still aligns with your objectives. You can track using your account statements, looking at performance ratios like the Sharpe ratio, which measures risk-adjusted return, or using various investment tracking apps available now.
I remember reading that story about someone catching an underperforming stock early. It wasn't just the market dragging it down. The company itself was having problems.
Right.
Because they were monitoring diligently, they spotted the signs and sold before it really tanked.
That's a perfect example of active monitoring paying off. It wasn't just watching the price, it was understanding why they owned it and noticing when the reason changed. And that leads right into knowing when to make adjustments, bigger ones than just rebalancing.
So when do you need to make those bigger strategic shifts?
Major life changes are a big trigger. Getting married or divorced, having children, changing jobs or income levels significantly, nearing retirement. These events often change your financial picture, your goals, or your risk tolerance, requiring a portfolio review and potential adjustment.
Like the young investor versus the pre-retiree example.
Exactly. Their needs are vastly different. Significant shifts in market conditions might also warrant adjustments. Maybe rising interest rates make you rethink your bond strategy, or fears of a recession prompt a move to more defensive assets. And persistent performance deviations, if a specific investment consistently fails to meet expectations for reasons intrinsic to it, not just market waves, it might be time to cut it loose.
That story about the colleague whose career change led to a much higher income.
Yeah, that was a great example. Their risk tolerance and ability to save increased dramatically. So they adjusted their portfolio to be much more growth-oriented, which apparently paid off significantly for them. It shows your strategy has to evolve with your life.
Okay, one massive piece of this puzzle, mentioned throughout the sources as a key long-term goal, is obviously retirement planning.
Foundational. Absolutely crucial for long-term security. The sources spend good time on selecting the right retirement account options. You've got your 401ks, often with that valuable employer match. Seriously, always try to get the full match if you can. It's free money. Contributions are usually pre-tax. Growth is tax-deferred.
And IRAs?
Traditional IRAs offer similar potential tax deductions and tax-deferred growth. Then Roth IRAs, as we touched on, after-tax contributions, but tax-free growth and withdrawals in retirement, really good if you anticipate being in a higher tax bracket later. And SEP IRAs for the self-employed, allowing much larger contributions. That colleague anecdote about maximizing the 401k and the match, it's simple but so powerful for compounding over decades.
So once you've picked the right accounts, what are the key strategies for actually saving enough for retirement?
Rule number 1, echoed everywhere. Start early and contribute consistently. Time and compound interest are your best friends. Setting up automatic payroll deductions right from your first job makes it almost painless.
Out of sight, out of mind.
Pretty much. Then, increase contributions gradually. Every time you get a raise, try to bump up your savings rate a bit before you get used to the higher income. Your lifestyle doesn't have to change much, but your savings can accelerate. Diversify within your retirement accounts, too. Don't just pick one fund.
What if you feel like you started late?
Leverage catch-up contributions. If you're 50 or older, the IRS allows you to contribute extra amounts each year, specifically to help you catch up. And, like everything else, regularly review and adjust your retirement strategy based on your progress, timeline, and any life changes.
It definitely sounds like a lot to keep track of. The sources do acknowledge that sometimes it gets pretty complex, right? And that's okay to seek help.
Absolutely. Self-education is fantastic, but knowing when to consult a financial advisor is also smart. Major life changes, like we discussed, marriage, divorce, inheritance, job change, often create complexities where professional advice is valuable. Retirement planning, especially as you get close and need to figure out how to turn savings into income, is another key time.
Or just feeling overwhelmed.
For sure, investment anxiety is a totally valid reason. If market swings or the sheer number of choices stress you out, a good advisor can provide structure, discipline, and act as an emotional buffer. And obviously, if you have complex financial situations, maybe you own a business, have multiple income streams, significant assets, an advisor can help coordinate everything tax efficiently.
Right.
That story about the family member inheriting money but feeling lost.
Right, the advisor bought peace of mind.
Exactly. Help create a plan and a portfolio, turning confusion into confidence.
Okay, so if you decide you need help, how do you pick the right advisor? Because they're not all created equal, as the sources point out.
Really important point. You need to do your homework. Check their qualifications, look for credentials like CFP, Certified Financial Planner, or CFA, Chartered Financial Analyst. These signal rigorous training and ethical standards. Understand their fee structure, how do they get paid? Fee only, often seen as less conflicted. Commission-based or fee-based, a mix. Make sure you understand potential conflicts of interest.
And you have to feel comfortable with them, right? It's personal stuff.
Hugely important. Assess compatibility. Can you talk openly with them? Do they listen? Do they explain things in a way you understand, or do they use jargon? You need trust and clear communication. And review their track record. Ask for references if possible, look for testimonials, and check regulatory websites like Finarize BrokerCheck for any disciplinary history. That colleague who went through a couple of advisors before finding the right fit.
The one who finally found someone who clicked.
Yeah, someone who understood their goals and explained things clearly. That relationship turned into a really fruitful long-term partnership for them. It's worth taking the time to find the right fit.
Wow. Okay, we really have covered a huge amount of ground here, haven't we? From the sheer power of starting early with investing to setting those clear goals, building that safety net with diversification, actively managing risk, exploring the different tools like stocks, bonds, real estate, then making it tax efficient, building and maintaining the portfolio through rebalancing, focusing specifically on retirement, and finally knowing when and how to get professional help. That was quite a deep dive into your source material.
It really was. And, the core message that seems to thread through all these different sources feels pretty consistent, doesn't it? It's like invest early for compounding. Use clear goals as your map. Diversification and allocation build resilience. Managing risk protects your capital. Understand your options. Boost returns with tax efficiency. Stay on track with monitoring and adjustments. And make retirement planning a priority.
Yeah, and these aren't just like academic theories. They feel like practical, actionable steps. Things you can actually do that consistently over time can genuinely make a big difference in building wealth.
Absolutely. And thinking about this whole journey, all the planning, the monitoring, the adjusting, it kind of leads to a final thought, maybe a question for you listening. If investing truly is this ongoing journey, what's maybe one small concrete step you could take today based on something we've talked about to either start sketching out your own roadmap or maybe just to check your current position on the map you already have?